Year to date, there have been hawkish repricings of central bank policy rates, and some central banks have started hiking interest rates. The hawkishness was mainly triggered by the Middle East conflicts and the resultant high energy prices. For example, at the start of the year, market priced in more than 2 Fed funds rate cuts for this year. And as we speak, market priced more than 1 Fed funds rate hike. Our base case for most major central bank policy outlook has not been as hawkish as market pricings. Our expectations are based on the assumptions that energy prices ease gradually and the pass-through of inflation pressure will gradually dissipate. Risk is for a more hawkish central bank reaction function should second-round inflation impact become more prominent. In this regards, wage growth and inflation expectations are key aspects to monitor. Back to our base case, we expect the Fed to keep the target range for the Fed funds rate unchanged through this year. Interest rates are at mildly restrictive levels. We see room for inflation to ease towards the later part of the year, and the US labor market is in a low hire, low fire situation. While stable, it is not overheating. However, the FOMC has been hawkish, and the June dot plot reflected split opinions, with 9 members expecting at least 1 hike this year, and 9 members expecting no change or a cut. With lingering geopolitical tensions, market is likely to stay at the hawkish side for now, guarding against the risk of rate hikes. Therefore, short-end US yields may be sticky downward for now, but may potentially ease towards our more neutral base case during the later part of the year. European Central Bank ECB hiked its policy rates by 25 basis points at their June meeting. We expect one more 25 BP hike before year-end, but do not expect a more aggressive hiking cycle at this juncture. We continue to see limited room for the Bank of England to hike interest rates, given that the BOE bank rate is high at a restrictive level, while there is downside risk to UK growth. But BOE has said it is ready to act as necessary. The Reserve Bank of Australia has hiked rates 3 times already. The RBA is likely in a wait-and-see mode now, letting the previous policy tightening to work its way through to restrain economic activities. We expect no more hike from the RBA. The Bank of Japan has its own agenda and had been hiking rates before the Middle East conflicts emerged. Policy normalization is likely to continue, with more policy rate hikes to come while quantitative tightening continues. We expect 1 more hike by the BOJ this year and 2 more hikes next year. We mentioned wage growth and inflation expectations are key aspects to monitor. Long-term inflation expectations, as reflected by market-traded inflation bond break-even levels, have eased across major markets, and in some markets back to pre-Middle East conflict levels. Wage growth was not as high as in earlier periods in the US and the UK. This backdrop may help mitigate inflation pass-through. That said, persistent geopolitical conflicts is a key risk to our benign interest rate outlook, and investors should caution against two-way risk in interest rates.